So let's start doing some short questions from chapter number 1, which is the context and purpose of financial reporting. Now, as we have seen that this chapter number 1 is a theoretical chapter, and we do not expect any numerical questions or questions involving calculations in it. You will get theoretical questions, probably 1 or maximum 2 questions from this chapter. So let's see question number 1.1. Who issues international financial reporting standards? And they have given us 4 choices: IFRS Advisory Committee, the Stock Exchange, the International Accounting Standards Board, and the government. Now here I can say that choice number B, Stock Exchange, and D, the government, they are irrelevant, because Stock Exchange and government, they have got nothing to do with issuing the standards. We are left with 2 choices, A and C, the IFRS Advisory Committee and International Accounting Standard Board. And the correct choice is International Accounting Standard Board, because IASB is the organization which issues the standards. IFRS Advisory Committee, on the other hand, it just provides advice. They do not issue the standard. Their role is there only for providing advice. Okay, then comes the next question, 1.2. Which groups of people are most likely to be interested in the financial statements of a sole trader? Now you should pay attention, sole trader. So choices are shareholders of the company, business bank manager, tax authorities, and financial analysts. Now first choice is gone because it says shareholder of the company. Now a sole trader is not a company, and there are not any shareholders. There is just one sole trader, or you can call it proprietor. So choice number 1 is invalid. Similarly, option number 4, which is financial analyst, it is also not relevant, because financial analysts usually they analyze the performance, the financial performance of businesses which are listed on stock exchange, which means companies, public limited companies. Sole traders are not the type of businesses where financial analysts are doing any kind of analysis. So because they do not have shareholders, they do not have shares, they are not sold or bought in the stock markets, so financial analysts are not involved in this case. The only option we are left with is business bank manager, yes of course, and the tax authorities, certainly yes. So option number 2 and option number 3, they both are correct, so it means that our answer would be option number B, which is 2 and 3 only. Then comes question number 1.3, which says which of the following statements are true. So are, it means that one option can be true or both can be true. So let's read option number 1. The shareholder needs a statement of financial prospects that is an indication of future progress. However, the supplier of goods on credit needs a statement of financial position that is an indication of the current state of affairs. Now that creates some doubt, because shareholders, they do not need statement of financial prospect, they need a set of financial statements. So this statement has some doubt, but let's read the second one also. The second option says the objective of financial statements is to provide information about the financial position, performance, and changes in financial position of an entity that is useful to a wide range of users in making economic decisions. This is absolutely correct, because this is exactly what we learned in our first lesson, the objective of financial statement. So statement number 1 is incorrect, because it says shareholder needs a statement of financial prospect. So what is financial prospect, by the way? Shareholders, they need financial statements, all of the 4 or 5 financial statements. So only option number 2 is correct. So it means that answer is option B, which says 2 only. Now let's move to 1.4, which says which of the following are advantages of trading as a limited liability company? Advantages of a limited liability company. So operating as a limited liability company makes raising finance easier, because additional shares can be issued to raise additional cash. Yes, this is true, but let's see the other one also. Operating as a limited liability company is more risky than operating as a sole trader. Now there, just in first sentence, there is a doubt, because it says limited liability company is more risky than the sole trader. It is wrong. because in limited liability company, liability is limited, whereas in sole trader, liability is unlimited. So sole traders, they have higher risk. So therefore the statement number 2 is incorrect, and our answer choice is where option number 1, statement number 1 is correct. So we can say that answer is A, 1 only. Now let's move to 1.5, which says, which of the following best describes corporate governance? A. Corporate governance is a system of rules and regulations surrounding financial reporting. No, it is not correct, because IFRS, they surround financial reporting. Corporate governance, it deals with all of the activities within the organization, how the organizations are run overall. So corporate governance is not only about financial reporting, it covers all of the activities. B option, corporate governance is the system by which companies and other entities are directed and controlled. Yes, this is the answer, and this is exactly the definition which we spoke during the class. So B is correct, but let's see C and D also, and I will explain what is wrong with that. So number C, corporate governance is carried out by the finance department in preparing the financial accounts. No, it is not about finance department. Number D, corporate governance is the system by which an entity monitors its impact on the natural environment. No, it is also not correct. That could be one part of that, but it is not the corporate governance definition. So B choice is correct. A, C and D are wrong. Number 1.6, which of the following statements is or are true? Which means that out of 1, 2 and 3 options, maybe one is true, maybe both are true, maybe all 3 are correct. So let's see. The directors of a company are ultimately responsible for the preparation of financial statements, even if the majority of the work on them is performed by the finance department. Yes, this is correct. This is what we discussed in the topic governance. So first is correct. Let's see second and third. If financial statements are audited, then the responsibility for those financial statements instead falls on the auditors instead of directors. No, it is wrong. Auditors, they are only checking the financial statements. Responsibility still lies with the directors. So statement number 2 is wrong. Statement number 3, there are generally no laws surrounding the duties of directors in managing the affairs of a company. This is also wrong, because there are laws. When you will study your paper F4, which is business law, you will see that legally what directors are bound to, and what they can do legally, what they cannot do. So there are limits on their authorities, and there are limits on their responsibilities. So there is a law. So statement number 3 is also wrong. So only option number 1 is correct, which means that our answer choice is A, which says 1 only. 1.7. According to the IASB conceptual framework, which of the following is not an objective of financial statements? Which of the following is not an objective? Providing information regarding the financial position of a business. This is true. Providing information regarding the performance of a business. It is true, because first option is balance sheet, second option is income statement. Enabling users to assess the performance of management to aid decision making. Yes, it is true, because this is the purpose, this is the objective, that we help users to understand financial statement and do the decision making. So option number C is also one of the objectives. Number D, helping to assess the going concern status of a business. Now this option is not correct, because it is not the objective of financial statement, because here they use the word what is not the objective of financial statement. So assessing going concern status is not the objective of the financial statement. So our answer choice is D. So D is the answer, that it is not the objective of financial statements to assess the status of a business as a going concern. All A, B, C, they are correct. They are the objectives. (1.8) The IASB conceptual framework identifies user groups. Which of the following is not an information need for the investor groups? So if you remember, when we were doing chapter 1, we discussed the needs and what the different groups, how do they use financial statement, what type of information they are looking at, because we said that different group of users, they look for different type of information. So what is the information which they said which one of the 4 following option is not an information need for the investor group? So what investors are not interested in? I mean, out of these 4. So first is assessment of repayment ability of an entity. Okay. Number 2, measuring performance, risk and return. Yes, of course, this is what investors they are looking at, performance, risk and return. Taking decisions regarding holding investments. Yes, this is true. This is where they take decision about their investments. Taking buy-sell decision, buying or selling of a business. So this is also what they are doing. So B, C and D, all 3 of them, they are related to investor group. Investors are seeing for them. But for assessment of repayment ability of an entity, this is not, because repayment ability usually is done by the lenders like bankers or suppliers. Investors are not the lenders of business, so they do not see of the repayment ability of an entity because they don't give loan to this one. So this assessment of a repayment ability, it should be of interest to someone who is giving a loan to a business, because he is interested in seeing if my loan will come back or not. So investors, they don't give loan to a business, they invest in a business. So you should understand that giving loan, lending money or making investment are 2 different things. So investors are not interested in option number A. So answer choice is A. 1.9. Which of the following statements about accounting concepts and policies are correct? So accounting concepts and policies, which statements are correct? And there could be more than one. So it says that companies should never change the presentation or classification of items in their financial statements, even there is a significant change in the nature of operations. So even if there is a significant change in the nature of operation, the company should never change the presentation or classification of items in their financial statements. This statement is wrong, because there are different types of businesses. Like a bank has a different, banking is a different business, manufacturing is a different business. And banking, manufacturing or retailing, these are different types of businesses, and within their financial statement they make the presentation in a different way. When they classify their income, expenses or assets or liabilities, they have different names and different classification groups. So when you make a significant change within the nature of your business, you must also make a change in the presentation of financial statements which is suitable for that particular nature of business. So this statement is wrong, because it says companies should never change. In fact, companies should always change. So statement number 1 is wrong. Statement number 2, information in financial statements should be presented so as to be understood by users with a reasonable knowledge of business and accounting. Yes, this answer looks correct. This is correct. Let's read it again. Information in financial statements should be prepared so as to be understood by the users with a reasonable knowledge of business and accounting. Yes, this is correct. This is what the conceptual framework says, that reasonable knowledge of business and accounting. It cannot or it should not be understood by any layman. Of course, there should be some knowledge, but you do not need to be an expert. That's why we use the word reasonable knowledge. So it means that you don't have to be very expert. So it means that you don't make statements in a very difficult manner or in a very complex manner. You make it in such a manner that any person who has some reasonable level of knowledge, so anyone with some knowledge should be able to understand. Option number 3 says companies should create large provisions in times of company growth so that they can be utilized in more difficult times to keep the profits the same. No. This is wrong, because the word is used provision. We will discuss the word provision in our chapter number 11. Provision is something, it is kind of a reserve. it is something that you set on one side. Provision means the money which you are not using and you are saving. But the word provision is for liability. Provisions you make for liability. So we do not make. So if we are saving money for future, it is not that we are doing it for liability. So that statement is technically wrong, because provision you only create against liability. But here the statement says that you should save the money for future when you may not have the money. So it is not a kind of a liability, it is your choice. So you may save money, but that saving should not be called provision. So statement number 3 is wrong. Only 2 is correct, so answer choice is D. Okay, then comes 1.10. Which of the following are true for partnerships? So true for partnerships. The partner's individual exposure to debt is limited. It is wrong, because we said that usually partners have unlimited liability. You should remember that there are some limited liability partners, which is called LLP, limited liability partnership. But this is not something which we take or assume as general. So generally when partnership, we use the word partnership, you immediately by default think of about an unlimited liability. So statement number 1 is wrong, because it says that partners have limited liability. No, they have unlimited liability. Statement number 2, financial statements for the partnership by law must be produced and made public. No, it is again wrong, because it is not a public limited company which should issue its financial statements. Yes, they do produce financial statements, but it is not their legal responsibility to make it public, because public, you only make financial statements of public limited companies, of listed companies, the companies whose shares are bought and sold on stock exchange. Only financial statements of those companies you make public. So option number 2 is also wrong. Option number 3, a partnership is not a separate legal entity from the partners themselves. Yes, this is correct, because partnership is not a separate legal entity. Separate legal entity only exists in case of companies. So partnership is the same as the partners. So option number 3 is correct. So our answer choice will be C. (1.11). Which of the following correctly defines equity according to the IASB's conceptual framework for financial reporting? So equity, actually it is the money which belongs to the owners of the business. So the word equity means the money which is in the business, but that belongs to the owners, to the shareholders. So let's start reading the options. Option number A, equity is the present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefit. This is actually the definition of a liability, that equity is a present obligation. No, equity is not an obligation. Equity is the money. It is the investment which belongs to the owners. It's not a liability. It's not an obligation. So A is wrong. B, equity is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. Now this is exactly the definition of an asset. So this is also wrong, because it means assets. C, equity is the residual interest in the assets of the entity after deducting all its liabilities. Yes, that is the answer. That equity is the residual interest. Residual interest means whatever remains in the end, whatever remains after paying the liabilities. So if you remember the balance sheet equation, assets is equal to equity plus liabilities. And I can rearrange this equation by saying that assets minus liabilities is equal to equity. Now this statement number C is actually about this equation, that equity is the residual interest in the assets of the entity after deducting its liabilities, which means assets minus liability is equal to equity. So you have assets. When you pay out the liabilities, for example, you have $100 of asset and your liabilities are $40. So 100 minus 40, whatever is remaining 60, that is the residual interest, that is the equity, and that is something which belongs to the shareholders. So C is correct statement. Number D. By the way, there should be only one answer, because one choice. So C is correct. We already know the answer. Answer is C. But let's explain the D as well, that why D is not the answer. So equity is increase in economic benefit during the accounting period in the form of inflows or enhancements of assets or decrease of liabilities. No, this is the definition of income. Option number D is actually the definition of income. So answer is so our answer to this question is C. Okay, 1.12. Which of the following statements are true? Directors have a duty of care to show reasonable competence in their management of the affairs of a company. Very true. One is correct. Directors of companies must act honestly in what they consider to be the best interest of the company. This also looks correct. In fact, it is correct. Number 3, a director's main aim should be to create wealth for the shareholders of the company. Yes, this is what we discussed in the governance part. So all 3 statements, they are correct. And if you pay attention, it says which of the following statement are true. So it means that you could have more than one answer. So all 3 statements are correct. Our answer is C, 1, 2, and 3. Now let's see the next one, 1.13. Which of the following statements are true? The IFRS Interpretation Committee is a forum for the ISB to consult with the outside world. No, that is not correct. It is not a forum for ISB to consult with the outside world. Interpretation Committee, their job is to interpret the financial statements and sometimes to interpret the accounting standards, and if there is any gray area or any lacking or any contradiction in any financial standard, they issue interpretations which can be considered as annexures to the standard, additions to the standards. So it is not their role to consult with the outside world. Is wrong. Option number 2, IFRS Foundation produce. No, not the foundation. IFRS Foundation is the parent body. Activities, they don't produce the standards. It says the IFRS Foundation is overseen by no, it is wrong. They have put everything upside down because is under that. No, it is wrong. IFRS is at the top. It supervises all the activities. ISB is under IFRS and ISB makes the standard. So option 2 is absolutely. So we are left with only objectives of the IFRS. Third statement is correct. Foundation to bring about conversion, to bring something at one. Some differences, sometimes there are some deviations. Standards and IFRS. IFRS Foundation tries to make 14. What is the role of setting and regulatory process? Reporting standards, which means reporting standards. Yes, this is true. The accountancy profession. No. Develop and issue the standard. So answer is B. So for 1.14, the answer is B. In short questions, I have given you some explanation. These questions have been taken from as you want. Now this is a conceptual chapter. All theoretical extra questions from other books taken from BPP book. You may take any other source for doing more practice, and also you should read the chapter as well.